Hi, Ashley Pratt here with Fairway Independent Mortgage. And today I wanted to talk a little bit about appraisal gaps. And what an appraisal gap is the difference between the sales price and the appraised value. Right now in our market, most buyers are having to bid significantly over the list price, and in some cases 10 to 15%. And the concern is, will it appraise? So I wanted to just take a minute to give an example of how you can use mortgage insurance, sometimes known as appraisal gap insurance, to help bridge that gap. So I'm going to share my screen here and give you some context to what this could look like. So over here on my screen, you can see here that in this example, we had a sales price of $435,000 and it ended up appraising at $390,000. So initially this was set up with 20% down. So their loan amount was 20% of that sales price of $435,000. So their loan amount was $348,000. Their payment was $2,013 and cash to close of $87,000. And again, this is just for example purposes. These interest rates are dated for sure. Rates are closer to 4% now. Then the appraisal came in at $390,000. So when that appraisal came in at $390,000, in order to maintain that 80% loan to value, we would have had to now base our loan amount 80% of that appraised value. So we would have had to lower our loan amount from $348,000 to $312,000, resulting in the borrower bringing in additional funds to close. Now, because it's a percentage, they're not having to bring in $45,000 difference, which is the difference between the sales price and appraised value, because it's a percentage. But they are having to bring in $123,000. And of course, the payment's lower because the loan amount dropped. However, in these two columns to the right, you can see how if we introduced mortgage insurance by either basing the loan amount 85% of the appraised value or 90% of the appraised value, how we can bridge that gap. And in the case of 90%, not increasing their cash to close at all. So let's look at the 90% option here. So if we went ahead and based our loan amount on 90% of the appraised value of $390,000, our loan amount would be $351,000. But because we no longer have a 20% equity position, we would have to introduce mortgage insurance. And we have two options for that, of course, depending on your qualifications. But assuming that you would qualify, we could either introduce monthly mortgage insurance, which in this case would be around $64 a month. So your payment would go from $2,013 to $2,090, and your cash to close would actually lower by $3,000. Or you can pay a single premium mortgage insurance of around $2,500. So you pay a one-time fee of $2,500, sure beats $45,000, right? And your monthly payment would go up by $13, and your cash to close would be $500 less than what you had originally expected. So you can see that in this example, a borrower who's putting down 20%, they can simply just increase their loan to value. Instead of changing their loan amount significantly, it just moves the loan to value up, which introduces mortgage insurance, which we can either do monthly or in a single premium, which the end result is, in this case, about $13 more per month. So if you're currently in the market looking to purchase a home and you have some concerns around appraisal gaps and what that might mean for you, our team is here and happy to help you evaluate your options. So again, Ashley Pratt, Fairway Independent Mortgage. Hope you have a phenomenal day.